There is such a thing as too much choice, and the overwhelming range of markets, styles, and timeframes available out there only compounds the confusion. Be it for a lack of technical knowledge or falling for the next social media influencer who was paid to shield its brokerage sponsor, most ironically end up making the worst possible choice by picking the exact strategy that will maximize their odds of ruin. So if it has been your journey so far, I'm here to tell you, you can do a whole lot better than that for yourself. There is a clear-cut method to definitively narrow down the set of markets and styles that you should trade in priority, and this is precisely what this video is going to unpack. So sit back, relax, and let's ponder how to pick a playing field that will maximize your chances of success this time. Confusion is not as much born out of too many possible choices as it is from a lack of constraints. Imagine meeting on a Saturday evening at your favorite Italian restaurant with your friends, but one of them is running late. There's no way to get in touch with him and you will have to order for him. Everybody likes Italian food, so the likelihood that just about every item on the menu will appeal to him is very high. So how could you possibly know what to choose for him? Well, what if you knew that his budget is strictly limited to $50? That he prefers mozzarella over ricotta cheese, that he does not eat pork, that he is allergic to pistachio, and that the restaurant is out of mushrooms to lay on a pizza or stuff the ravioli with tonight. That would make your job that much easier, wouldn't it? Well, this narrowing technique is the exact same one that we'll be applying to your choice of markets, methodically. That might be what you want to trade, but especially, there is what you can't trade based on your own constraints. And in fact, there are 4 distinct types of constraints that you should learn to leverage to your advantage. Before we go over them one by one, it is essential to establish a baseline in order for you to comprehend why you should turn to such and such asset or trading frequency or instrument depending on your own personal circumstances. Note here that we are not going to go over the why of that baseline today because it would take us way past the scope of this video. This is a topic that will be specifically addressed in a more advanced class later on. So for the sake of our demonstration today, all that I want you to do for now is keep the following frame of reference in mind. When it comes to assets, the order of trading complexity rises as we move from mutual funds to ETFs to single stocks to commodities to cryptocurrencies, all the way to Forex being the absolute hardest asset class to trade. Now take a second to pause here and reflect on the fact that I am placing Forex at the very top of the difficulty ladder when this is arguably the most advertised asset class pushed to retail by pseudo traders on social media. Interesting, isn't it? Anyway, moving on. When it comes to trading frequency, difficulty will generally rise along with how often you intend to trade. So the closer you get to intraday, the harder and more demanding it gets. And lastly, when it comes to trading instruments, difficulty will rise as we move from cash spot trading to leverage spot trading to CFDs to futures to options. With this baseline now well defined, let's review the first constraint to consider in order to help you decide on where to start. We're going to begin with the first and most obvious set of limitations, your own. Your technical skills come first in line in this equation. Regardless of the time frame that you intend to trade, your skill set should be reviewed against your knowledge of the pricing mechanism of the asset that you are targeting, as well as your understanding of the instrument that you are planning to trade it with. Much of it has obviously to do with your overall mathematical proficiency and your mastery of key financial concepts, such as the notions of expectancy, position sizing, or portfolio building and decorrelation that we reviewed in detail in Series 1 and 2. Most traders though, novices in particular, will generally skip that work of self-review entirely and jump into a market with no other decision driver than the expectation of profit touted on social media. For example, much of retail will jump straight into Forex with nothing in their toolbox but silly chart drawings and candlestick patterns, chasing elusive trends that don't exist in this market, or without being clear about the true nature of limit orders on MetaTrader and the tremendous impact that slippage will have on their net performance. And then they learn the hard way. You have to learn to walk before you run. Now I understand that it might be hard to gauge right off the bat how little you know about a particular market or trading instrument. After all, as the saying goes, you can't know what you don't know. I get that. So in order to protect yourself, you need to come back to our baseline and use the following process as your rule of thumb if you are unsure about your abilities. Look again at this 3D chart. On each axis, as you move away by one increment from the 0 point, You should be able to spontaneously articulate very clearly what core technical changes will need to be applied to your strategy to fit the requirements of that next market or time frame or instrument for them to be traded successfully. And especially what documented, quantified proof you have in your possession to back up the claim that you do have an edge. It should be actual research produced by yourself that you could justify in front of a scientific jury, nothing less. That's a high standard, I know, but it is crucial that you set the bar this high. It will keep you from being overly optimistic and straight up lying to yourself about your abilities. You have to realize that refusing to go through this stringent process of self-due diligence will not make the outcome any easier for you. In fact, it will make it worse, because if you don't, the market will still do it for you, but for a cost this time. So if you're not clear on any of your proofs of claim or start babbling about them, that's okay. It only means that you're not ready. Hit the pause button, save your hard-earned capital, keep learning, and keep trading what you're trading already. There is nothing wrong with that, and the market is not going anywhere. Come back to it when you are prepared. Let me illustrate all that with a quick example. As you can see, the 0 point is what is recommended for just about everyone. That means simply delegating money management to a professional, which typically takes the form of piling money in a mutual fund in a retirement account, aka buying and holding for the long haul. From there, the chart shows that your first step as a trader is likely going to be trading spot ETFs on a very low frequency, such as on a monthly basis. If you wish to graduate to that level, you're gonna have to ask yourself hard questions such as, what do I really know about ETFs? How are they built and rebalanced? Where does their liquidity come from? What's the cost involved? Why should I choose one provider over another? And especially, do I have a quantifiable strategy to bring to the table that the market will reward me for on top of passive buy and hold? Or am I expecting a free lunch here? Plain and simple, am I for real or am I just bullshitting myself? You get my drift. You have to be your worst critic and harshest scrutinizer. Treat that due diligence on yourself like you would on a financial advisor. That first work of self-assessment alone will weed out a lot of options that you would have otherwise considered in the past. Now let's refine our approach with another set of personal constraints. What kind of trader profile do you have? That one has more to do with your own personal situation, and you should be able to go over it fairly quickly. To simplify the process, you're going to want to answer the following 3 questions as generally as possible. Namely, do I have a yearn for getting involved in daily action by sticking to my screens as I make trading my full-time gig? Or do I just want to keep a mostly set and forget, hands-off approach, keep my full-time job instead, and generate some extra cash on the side? Second question, how do I deal with randomness in general? Do people who live with me tell me that I tend to get impatient, frustrated, and worried by adverse events that I can't control? Or on the contrary, do they turn to me to rely on my patience, self-control, and to gain insight from the flexibility of my expectations? And third question, is the scope of what I'm trying to undertake going to only affect me, or will it have any potential impact on the well-being of my family, be it as relates to my behavior around them, or the financial impact of my decisions on the household going forward? The personal trader profile resulting from that work of introspection should yield the added constraints to help you decide on what to trade. Quite clearly, if you want to keep your day job, you're known for biting your nails and losing sleep, and you're a single parent with a set of newborn twins, you're not going to want to quit your job to do intraday futures trading on cryptocurrencies. Instead, you would likely want to consider something like swing trading a blend of ETFs, or maybe single stocks depending on your skill set, and keep it to a few monthly rebalancing trades only, within a system calibrated to realize only half or even just a third of the market's volatility. It may seem like common sense when described in these extremes, but I can see too many traders picking a market or a time frame that simply does not match their lifestyle and is completely incoherent with the expectations of those around them. And trust me when I say this, if those around you are not on board and 100% supportive of your trading plan, you are setting yourself up for failure, and not just in trading. So spare yourself the headaches and try to use your own profile as a way to further refine your selection. The third layer of limitations that will certainly simplify your available set of options is without a doubt the scale of your risk capital and what you intend to achieve with it. A lot of intentionality is often attached to starting a trading business, be it full-time or part-time, doesn't matter. It is rarely done aimlessly just for the sake of money alone. Likelier than not, it fits into a bigger picture where it makes sense when considering your larger financial plan. And for that plan to be fulfilled, it will require you to pick your markets carefully. Let's review a few use cases to illustrate my point. The default setup is most often people wanting to spice up their 401ks with a more aggressive side investment by using some marginal extra money, usually less than 5% of their total investments. In that case, you would not even have to worry about the focus of your trading gig to even make sense with your retirement account from a risk-adjusted perspective. It could literally stand on its own, and you would treat it like a hobby. In that case, you could easily decide to trade index futures on a daily or even an intraday basis, because the goal here is definitively more focused on the return than the risk-adjusted return. However, should you want to use that risk capital as a comprehensive layer of investments to bolster the aggregated resilience of your mom and pop's retirement funds, then it would make sense to focus your attention on heavily decorrelated markets such as commodities and swing trade a stack of a few of them, say gold, wheat, oil, or natural gas, on a daily or even a monthly basis. That would totally fit the bill of trying to maximize your overall risk-adjusted returns in that case. Another use case for your risk capital that is susceptible to give you a good hint of where to plant your trading flag would be if you wish to find a position in a trading firm. In that case, you would probably have to specialize and excel in one or two specific markets and most likely have to trade them intraday to avoid keeping overnight positions. Likewise, if the goal of your risk capital is to build a track record to help you attract capital for your own hedge fund, then you would likely have to diversify the number of markets traded in order to enhance the correlation. And you would most likely have to keep your targeted time frames to no faster than daily and your universe to only the most highly liquid stocks and futures contracts in order to keep your strategy scalable to a large amount of capital allocation. As you can see, picking a market is not just about making money, far from it. There is most likely a more profound underlying rhyme and reason to your endeavor that will greatly guide your choices or straight up dictate what you should do for these strategies to make sense with your end financial goal. And lastly, let's talk about the last set of constraints. There is no way around them, unfortunately. Regulatory limitations. There is no shortage of them. So even though they are a net negative for investors as a whole, try at the very least to use them to your advantage in order to funnel your market picks more efficiently. Regulations will mostly affect three facets of your trading business, and the first one relates to taxes. Obviously, everyone's situation is different, including within the same country, and you will have to consult with your tax advisor on that. But chances are that your government will not extort you to the same tune depending on the market that you trade, how you extract your profit from it, and the amount of time that you hold your positions for. For example, in most Western countries, you are losing out on a major tax break by holding your positions for less than a year and realizing short-term gains. Some countries are even more stringent. The US particularly prevents investors from using conventional margin within a retirement account. If you do, then the IRS is likely to consider that you put up your IRA as collateral for a loan, which is what margin is, and will consider it fully distributed at that point, which will create a major and potentially catastrophic tax event. So there is no trading with conventional leverage in a tax-friendly manner in the land of the free. At most, can you get limited margin to help you rotate your positions before full settlement is achieved, but that will be the extent of it. So if you are not considering more complex instruments such as futures to get that leverage effect, then your tax situation alone could be a major influencer in choosing your trading strategy if you are looking to include it within a tax-conscious management of your estate. Also, trading too frequently could trigger your gains to be treated not like an investment profit, but instead to be requalified as a business income with all the convoluted tax implications that it entails. In the US as well as most of Europe, for example, if you're not planning for your trading to become a full-time job, then you better watch how often you hit these buy and sell buttons. And here are a few extra examples for you, all of which can change overnight at the whims of your politicians, of course. In the UK, spread betting is totally tax-free. In France, crypto-to-crypto transactions are not taxable, regardless of gains. In Germany, long-term crypto gains realized after holding for a year are tax-free. In Dubai, trading gains are tax-free altogether, etc. I think you get the picture. There is a myriad of jurisdictions and different tax legislations that will end up being very compelling in guiding you as you try to pick a market, an instrument, or a time frame. You will quickly realize that some of your initial choices might make absolutely no sense at all on an after-tax basis, and that your remaining options might require pivoting to alternative strategies entirely, up to the radical solution of packing your bags and moving abroad, and including renouncing your citizenship if you are really hell-bent on pursuing your dream without any parasitic authority breathing down your neck. Next, the second way that regulations will affect your choice of strategy is much more brutal. It is straight up whether or not such and such market or instruments have not been entirely banned by your government. As you will find out, a lot of countries have indirectly formulated a claim of ownership over their citizens' assets by telling them what they can and cannot do with their private property. Entire asset classes have been banned. Since 2016, for example, forex trading has largely been banned in Belgium. In Europe as a whole, traders have been forbidden to trade US ETFs, believe it or not. In the US, The CFTC was one of the first institutions to nationally restrict its traders from trading with overseas forex brokers, which has resulted to this day in US traders being confined to prohibitively expensive brokers and an even greater probability to go bust. Lastly, in India, the government is making it increasingly hard for people to access private cryptocurrencies. Now, it should be specified that in most cases, you can circumvent these restrictions by getting yourself requalified from a retail to a professional client, and that's assuming that you tick all the boxes, of course. Still, as you can see, accessing such and such market or instrument should be far from taken for granted, and you should always check with your local laws if the strategy that you are planning to deploy will indeed be allowed to be put into production. And to finish, the way regulations might narrow down your choices of strategy even further is through the way they affect trading costs. Once again, regulations rarely come in just the form of restrictions. Institutionalized racket is often attached to them too. Let's illustrate that point again. You will need to investigate, for example, whether stock trading is applied a stamp duty. In Europe, many markets are subject to a transaction tax, regardless of your location as a trader, a tax that will obliterate any hope of becoming profitable with a short-term strategy. Also, some markets have been regulated in such a way that leverage is capped. On Forex, the US started a trend which has now spread overseas. What it means is that an intraday strategy that would have made sense with a leverage of 200 to 1 might no longer do with a cap at 30 to 1. And regulation has a cost for banks and brokers too, a hefty one. So very often, unless their operation is huge like interactive brokers for example, it will be very hard for them to offer ultra discounted commissions or thin spreads at scale. This is especially the case in countries that are not well served by brokerage companies and where competition is low. So imagine paying huge fees per side per contracts and futures, for instance. That too could potentially restrict your trading sites away from a particular market or strategy simply because trading costs would be too prohibitive to pull a profit. And finally, the cost, time, and logistics required to merely compute taxes might deter you from trading a market altogether due to the insane tax requirements of your national tax agency. Crypto trading in the US, for example, has been turned into a violent headache as far as self-reporting goes. So before you engage in it, you better make sure to either have great in-house reporting tools offered by your broker or a superhuman accountant by your side, and assess the cost of their service against what you're planning to make after tax. It has to make sense. Now before I close out this video, I'll quickly throw a last one in. I almost forgot. What about your time zone? If you plan to trade Asian stocks while residing in California, you might want to reevaluate your life plans altogether. I think I got my point across by now. With all of these aspects carefully considered ahead of time, picking the correct market and strategy that are compatible with your life and wealth building plans should become a lot less confusing. So just grab a notepad and start going through these categories one by one to help you filter out most options. Then use that short list as your starting ground for your trading research. Careful planning is as important as quantitative work if you're taking trading seriously, and this diligent homework to save time and money will prove to be the best way to make your plans pay dividends even before placing a single trade. I'll talk to you in the next one.